Welcome to Retirement Today. I'm your co-host, Zach Holcomb, and alongside me we have Michael Reese, founder and president of Centennial Advisors, headquartered right here in beautiful Austin, Texas. Mike, we've got a great show on our hands this evening, but first of all, how are you today?
I'm always doing awesome. You know that. I'm just generally a happy guy, except for we're going to talk about taxes again today, but that doesn't make me happy. But, generally a pretty happy guy.
I always ask because if you're having that one bad day, I just want to make fun of you for it. That's the only reason I ask. But hey, we have a great show on our hands today. Now, we're going to talk a lot about taxes. That's a frequent topic on our program if you're a listener. But today's show, we have a great question that we're going to be answering. It may seem like a simple question, but it's a big one, and there's a lot we have to cover on it. Now, Mike, we're going to be talking a lot about when should you do a Roth conversion or a big Roth conversion? When's the right time?
Yeah, not necessarily just a regular. Probably the most common question I get when I talk, as you're listening, you call up the show and you say, hey, I want to talk to you, Mike, or maybe one of your team. Far and away, the most common question we get is, how much should we do? We know we should do a Roth conversion, but how much should we do in a Roth conversion each year? And that's a common topic. But one of the questions that I think that we need to talk about is, when do you do that huge Roth conversion? And so I have this little rule, right? I call it the rule of threes. Do you know what that is? The rule of threes?
Tell me about these rules.
Okay. Mike's rule of threes.
Okay.
When I come across the same question at least 3 times, then I say, all right, I guess I better talk about it on the radio show.
Yeah. I'm pretty sure you've come across this question probably 30,000 times.
It's come across a lot more. Yeah, but it's the big... So this all started, I had a gentleman in our office, real nice guy, right? And he has $3 million in his 401k.
He's done a great job.
And, I know what you're thinking. You're thinking, I want to be that guy.
Right? Definitely.
And so he was trying to figure out, well, what would a Roth conversion schedule look like? When we did the math in his case, here's what his schedule should look like. And this is what I told him. You need to convert it, all of it now. Like, not bits and pieces, all of it now. Can you imagine that? Like being told, hey, you've got $3 million in your 401k. You need to convert all of it now to Roth. Because when you convert from a 401k or an IRA to a Roth, what's happening? You're moving from an account where you're going to pay tax on it later to an account that's going to be tax-free for the rest of your life. But in order to make that transition, you've got to pay tax on the amount you convert.
Right. So in his case, it was just ripping the Band-Aid off.
Talking like $1 million tax bill.
Pay it all now.
Right. So we want to talk about that tonight. And, when do you do something like that? How do you know that it's a right time to do a large Roth conversion? I had another case, a very, super nice guy I was talking to. Between he and his spouse, they've got about $1.5 million. And in their case, the answer was not do it all this year. You know what the answer was? Do all of his this year, do all of hers next year.
Right.
That was the right answer. And again, that's kind of counterintuitive. You're like, well, why would I do these huge Roth conversions now? Pay a boatload of taxes now? Like, how does this benefit me in the long run? So how do I know that that's the right move versus doing it in bits and pieces? Because traditional thinking is you should do Roth conversions in bits and pieces.
Right.
Not all at once. Yet, here's reality. Sometimes when you have larger retirement plans, like larger 401ks, larger IRAs, it does make sense to do it all at once. The third one that happened. Another person comes in, they've got $2.5 million in their 401k. Same kind of thing, right? When should we be doing? It's so funny. It's like, I know I need to be doing Roth conversions. That's exactly what, let's call him Jack. Mike, I know I've got to be doing Roth conversions, but I can't get anybody to help me do the math to figure out how much I should do each year. We did the math. And in his case, again, just do it all at once. And man, his comment's like, oh my gosh, why do I want to give all that tax money to the IRS right now? You know what my response was? It was, well, why do you care? It's not your money anyway. You're just giving the IRS their own money.
Right.
It's not your money. It's their money.
People don't see it that way, though, sometimes.
Yeah, so this is what we really want to dive into tonight. So I think what I want to talk about tonight is we want to talk about what is reality when you're looking at your accounts. So mistake number one, probably the biggest mistake I see over and over again that people make when it comes to tax planning, especially with their IRAs. So when you think about this is the number one mistake. You look at your IRA statement. So let's say you get your statement from Fidelity. These days you don't get statements, right?
All online.
No, it's all online. So you go online, right? And you're Fidelity, say, or Vanguard. So you go online to Fidelity or Vanguard or wherever your money is. Or your 401k, doesn't matter. You go online and it shows you your balance. And it says, oh, you've got $1 million. You have 500,000, you have 200,000, you have 2 million, doesn't matter. You've got whatever your balance is. And immediately, this is a mistake right here. You see that number and you immediately think to yourself, oh, I've got $1 million in my 401k at Fidelity.
Sure, it says $1 million on the paper.
And it's got your name on it.
Yeah.
It says your name, it's your account, and the balance is $1 million. And it's an IRA or a 401k or a 403b.
Mm-hmm.
This is right there, mistake number one, biggest mistake that people make over and over and over. And this is what, if I could wave a magic wand, let's say I had a magic wand, first of all. So we're going to pretend I went to Hogwarts School of Witchcraft.
Got your wand.
And Wizardry, and I have a wand. And in this wand, this magic wand, I could make one change. This is a change I would make. The change I would make is when you get your 401k statement or your IRA statement, or you see it online, your account online, the change I would make is I want the name of the account to change from Joe Smith 401k to Joe Smith and IRS's 401k. And then the other change I make in my magic wand is I would wave it, and on your online account there, you say, oh, $1 million. And what it says is, it literally says, Joe, here is your portion of it, $650,000. And then below that, here's the IRS's share of your money, $350,000. Because when you go online and you see your account is worth $1 million, if it's a 401k, an IRA, a 403b, traditional IRA, you have to remember this is money that's never been taxed. And you have to remember it's not all your money. You are in a business and your silent partner is the IRS. They have a share of that IRA. They have a share of that 401k. You don't have $1 million. You really have about $650,000. And once you understand that, now you're in a position to make smart moves or smart financial choices from a tax perspective.
Yes.
You've got to start with understanding what is real and what is true. When you have $1 million in your traditional 401k, you don't have $1 million. You've got about $650,000. The IRS has $350,000. When you have $1 million in your Roth IRA or Roth 401k, then the truth is you have the full $1 million. The IRS owns zero amount of that account. But a regular IRA, a 401k, a 403b, it's like $1 million house with a $350,000 mortgage on it. You don't own 100% of that asset. You own part of it. And once you understand that, you can start making good decisions. All right. Now, I know I'm running up on the clock here. Here's what I want to tell you. Tonight, we are talking about, let's imagine you got that big IRA, that big 401k. When I say big, I'm talking over $500,000. And you're trying to figure out, when should I convert this to a Roth? You know it makes sense, but when should you do it? Should you do it in bits and pieces? Should you do it all at once? What should you do? Well, that's a complicated question, right? Taxes are complicated. Our job, we want to make it easy. I like to make stuff easy.
Easy peasy.
Easy for me is a happy thought. So we have created for you, if you're in that position, you were asking that question, for you, we have created something we call the Prosperity Planning Blueprint. It's a one-page piece of paper. And on this one-page piece of paper, what we've done, there's so many things you got to think about with your retirement planning, your financial planning. We thought, how do we drill down to the 3 core items that you have to get right to truly live a prosperous financial life? Those 3 things are, number 1, you've got to get your money set up right. You've got to invest it asymmetrically. Number 2, you've got to have a paycheck replacement plan. You got to make sure that your money will last. And number 3, you got to get your taxes right. That's what we're talking about tonight is taxes.
Yep.
So if you're in that position, you got that big 401k, that big IRA, give us a call. Let us create for you absolutely free a prosperity planning blueprint, and it will help you answer these questions about Roth conversions and timing. Zach, how do they get their free prosperity planning blueprint?
Mike, all they have to do is give us a call at 512-886-5850. Again, that number's 512-886-5850. Now, don't go anywhere. Stick around. We're going to be continuing our discussion on Roth conversions when we come back. Mike, our show has started off awesome this evening. We're talking all about doing Roth conversions, and not just Roth conversions, big Roth conversions. When is the right time? Is it right for you? Let's dive a little deeper into this discussion.
You bet. So here we go. That's what we're talking about. Let's imagine you have a large retirement account. You have over $500,000 in an IRA, traditional IRA, not a Roth, a regular old-fashioned IRA, or a regular old-fashioned 401k, or 403b, or what have you, right? You're sitting on, you start, and heck, especially you've got over $1 million. And you're like,
Sure.
Holy cow, you've got $1 million, $2 million, $3 million, et cetera. And the question is, how fast should you do Roth conversions? Do you do them in bits and pieces? Do you do it all at once? How do you know when you should do bigger chunks, right? So I'm going to give you a couple of rules of thumb here that would indicate, these are indicators. Now remember, we're talking about taxes here, so this is not advice. What I'm going to share is information, hopefully good information. It's not advice because as fiduciaries, I can't give you advice about your situation unless I know about it. So, if you call in the office, call in the office, call in the show, you get that free prosperity planning blueprint that we talk about. You do that, then I can give you advice on exactly what the right thing is to do. But until you call in and I learn about your situation, tonight I'm giving you information.
Right. That's why the blueprint's so important because it's personalized to your needs, goals, concerns. It's for you.
Yeah, and it makes it easy, right? Yeah. Easy. I want to make this easy for you. So here are some indicators that would tell you maybe you're in a position where doing large Roth conversions early and paying some tax now, a painful amount, might make sense. Number 1, what if you're going to be in a pretty high tax bracket, not just while you're working, but in retirement? I have a gentleman, recently retired. Actually, it's funny. He retired and then he started working again.
Mm-hmm.
Right?
Funny how that works, right?
Yeah, basically what happened, he tried to retire and then his company called him back and they said, hey, would you, let's call him Bob. Mm-hmm. Hey, Bob, would you be willing, and this happens a lot, would you be willing to come back to work, but not working for us, but maybe as a consultant? Mm-hmm. He's like, okay. And I'll be darned if he doesn't make more money working less hours now than when he was working for him, right?
Right.
But anyway, he's sitting on a pretty large IRA, $1.8 million, right? But the problem is he's got pensions, Social Security. He's got big pensions, Social Security. He's got that 1.8 in his IRA, right? He's got other accounts. He is going to be near the top of the tax brackets. He's going to, if you're going to be over, say, $250,000 of income, likely, then this would be you, right? Yes. So let's imagine you're retiring. You're probably going to have over $250,000 a year in retirement income. And there are people like that, right? I know we all want to be like that, but there are people like that. Well, if that's you and you're sitting on like in this case, he has $1.8 million in his IRA. Actually, his 401k is what it was. I told him, I said, what did I call him? Bob?
Bob.
Okay. I said, Bob, based on the math here, and we show him, like we have software that really shows you this in dollars and cents. In his case, now check this out. By converting the entire amount all at once in 1 year and paying a boatload of tax, it saved him and his wife over his expected retirement lifetimes. Like they expected, hey, we're going to live 25 years in retirement, say. Over that period of time, it saved them over $5 million of tax.
That's a huge
Isn't
number.
that crazy? It was insane, the amount of tax it saved them. Over $5 million of tax saved over their expected lifetime by converting all at once. If they didn't convert, you just let it grow. You pull out your required distributions. That would lead to one level of tax. But by converting it now and paying tax now, it reduced their total tax in retirement by over $5 million.
That's wild.
I mean, how awesome is that, right? But if you think about it, why? No more RMDs. When they do pull money out, it's tax-free. And, if you think about it, when you've got required distributions, you pull money out of an IRA, it makes more of your pension taxable potentially. It could make more of your Social Security taxable. It makes more capital gains taxable. It makes everything more taxable, right? In this case, if it comes out as a Roth IRA, it doesn't have that negative impact. I couldn't believe it when I saw those numbers. It was incredible. Huge, huge. $5 million. Now, how much did it cost him, though? Like, you do the math. How much is tax on $1.8 million? Okay, if you do the math, you're like, oh, my God, that's like, assume like 37% top tax rate. And I'm going to call it 35%, kind of, it's a little more than a third. So say $650,000, $700,000. Do you think he was excited, Zach, to say, oh, Mike, thank you so much for this advice. I now have to write a check to the IRS for $650,000. Do you think that that's what he said to me?
Probably wasn't his favorite day of the week.
No. He's like, oh. And you know what he said? He said what a lot of people say. He goes, okay, Mike, I get it. I understand the math.
Right.
The math makes sense. Because we even looked at other alternatives. We said, well, what if we break it out over time? No matter how we broke it out, just doing it now made sense. And he's like, man, he goes, I just don't know if I can write that check. So I said, Bob, what if you didn't have to write a check? And of course, he's like, well, what do you mean? What do you mean? Like, what do you mean I don't have to write a check? I know I got to pay the IRS. I said, well, yeah, you got to pay the IRS, but I never said you had to write a check.
Right.
He's like, well, tell me more. I said, well, here's what you do. You're over 59 and a half. This is the magic age, 59 and a half. You're over 59 and a half. Here's what we can do. We're going to take the 401k. We're going to move it to an IRA because you can only do this in an IRA. You can't, to my knowledge, I'm unaware of 401k plans that allow you to do this.
Right.
We move it to an IRA. And you can do this like we use TD Ameritrade as a custodian. We use Fidelity as a custodian. Either one of them let us do what I'm about to share. We moved it to the IRA. We converted it. But what we did is we clicked a box. And the box says, do you want to withhold tax? We said, yes, we do. What percent tax? 37. So what happened? $1.8 million in the IRA. You click that little box that says withhold the tax. Now, Bob has a Roth IRA with his share of the 401k. He took his money out of the 401k, call it 1.1 million, 1.15. And the 650 that was the IRS's share, we said, here, Fidelity. We use Fidelity in this case because that's where his 401k was at. It's like, here, Fidelity, send the IRS their share in a lump sum. Just send them that check, and that's withholding. Bob didn't have to write the check.
Nope.
Now, yes, he had a 401k with $1.8 million. Now he has a Roth IRA with 1.1, right? Yeah, there's less money there. But this goes back to what we were talking about a little bit earlier on the show tonight. He recognized, like, it's kind of like, here's how he said it to me. He said, Mike, the way I look at it, It's like I got a $1.8 million home, and I've got a mortgage of $650,000 on it. He goes, by doing this, it's kind of like I'm just paying off the mortgage, right? It's just like I'm going to extract my equity out of the house. It's kind of like I'm selling the house, and now the house, I'm taking the money out of the house, the equity, and I'm just paying off the mortgage.
Yes.
Right? So he goes, but that's kind of what it's like. It's kind of like paying off a mortgage. Like when I sell a house, I pay off the mortgage. Why wouldn't I do that here? Especially if it saves me a boatload of tax over time. Well, yeah, it's a no-brainer, right? In his case, it was truly a no-brainer. And the fact that he didn't have to write a check to the IRS made it easy for him, made it doable for him. But remember, to do that, he had to be how old, Zach? Over what? Remember what the age was?
59 and a half.
59 and a half.
Yep.
Yeah, 59 and a half. So if you're younger than 59 and a half, you can't pull that trick off. So anyway, here we go. We're getting to the end of this segment. We got to take a quick break. But before we do, if you're in this position, you have more than $500,000 in your IRA or 401k, and you're wondering, like, what would a Roth conversion schedule look like for you? Should you do it in bits and pieces? Maybe the answer to that is yes. Should you do it all at once? Maybe the answer is yes. I don't know, but I can make it easy on you to figure out. All you do is you give us a call and let us put together a prosperity planning blueprint. Part of this blueprint, it's a one-pager. It's really easy. Part of this blueprint is helping you figure out where are you from a tax position. If you don't do anything, where are you heading? What kind of outcomes might you receive? On the other hand, if you do something, how much tax could you save? And we start looking at what's the smartest way to do that. So, Zach, to get this blueprint, let's make this Roth conversion decision easy. You're sitting there, you want it to be easy. Zach, how do our listeners make this easy?
Mike, all they have to do is give us a call at this number. It's 512-886-5850. Again, 512-886-5850. It's after hours. You're going to get our answering service. They're just going to gather your name, number, and a good time to call you back. Our team will reach out to you your requested time to help you put together this prosperity planning blueprint for you. Now, don't go anywhere. Stick around. We're going to be talking more and more about the impacts of Roth conversions. We'll be right back.
Number one question we get. Mike, how much should I convert each year?
Right.
Number one question. I know I got to convert some money from my IRA to my Roth. I know it makes sense. It's like these days, a lot of people understand this is a good thing to do. The question, though, is what type of schedule or conversion schedule makes the most sense for your unique and specific circumstances?
Right.
Tonight, we're exploring, when does a large conversion make sense? When does it make sense to just do a big conversion all at once? And by the way, before we keep going in the segment, I just want to throw out this number again. If you're sitting there and you're just saying, Mike, I just need a little help here. How do I make this easy? Well, just give us a call. Our phone number, 512-886-5850. Again, 512-886-5850. You just give us a call, and it's after hours. You get, I think Zach told you, you just get our answering service. They'll set up a time you talk with me, one of the advisors, one of the team members. We'll help you figure it out. We'll make it easy for you. But obviously on a show like this, I can't tell you exactly what to do because I don't know your unique circumstances. I can only give you what I hope is good information.
Right.
So with that as a prelude, let's dive into another little client story where a large conversion made sense.
Sure.
So talking to a gentleman, by the way, he might be listening. And so obviously I'm going to change the name. Anytime we tell you a story about someone, we always change the name to protect the innocent, as they used to say on Dragnet.
Yes.
I used to like to use the phrase Fred and Wilma Flintstone as our, hypothetical family,
Yes.
but I got in trouble because apparently that is, what is it?
Frowned upon.
Trademarks.
Well, we just said it again, so might as well use them for this example.
No, I'm not. I'm not going to use Fred and Wilma. I'm just going to reference that I cannot use Fred and Wilma. How about that?
Yes.
So in any event, talking to this really nice couple, and the husband, he works for one of the tech companies in town. Let's call him Dave,
Sure.
right? Dave, common name. I'm just making it up on the spot. So Dave works for a tech company. I'm not even going to say which one. But like a lot of tech companies in town, he was getting these options, right? Like they would give him for part of his job a bonus, but instead of giving him cash, they'd give him some stock.
Yeah.
Right? And then Dave, I said Dave, right? So let's say his wife's name is Brenda.
Okay.
I don't know. Again, just popped in my brain. I don't know why, but we'll go with that. Dave and Brenda. Brenda, she works with another company, a different company, and same type of deal, though. Another tech company, she also is getting company stock as, like bonuses. Now, here's the deal. Between them, they've got about $1.6 million in IRA, something like that. Actually, I'm sorry, in their 401ks, right? And, he's like 61, she's 58, so he's over 59 and a half, she's not. And they're just trying to figure out, hey, what makes sense for Roth conversions, right? So we did the math. Now check this out. In their situation, right? And they wanted to retire on like $10,000 a month, so $120,000 a year. The problem was that, later in their late 70s, early 80s, by the time you did the math, their required distributions are like $165,000 in 1 year just by themselves.
It's up there.
Forget about Social Security and all the other stuff. Just the required distribution, and they're getting in their 80s, and now it's projected to be like $230,000. I mean, it's just crazy numbers, right? So we did the math, and we said, they called in. They wanted a blueprint. That's what we talked about. When you call our number, we'll put together a blueprint. It's free. It's simple. It's easy. So we put that together for them. And when we did the math, we said, all right, you're 61, she's 58. Let's assume a 30-year retirement here, because they wanted to retire here in the next year or two. Let's just assume 30 years out. How much in total tax are you projected to pay doing what you're doing now? Assuming that the tax laws don't change, because we don't know. I mean, we know they're probably going to change. We don't know how. We know they're not going to go down, right? I mean, that's not going to happen. If anything, they'll just get worse.
Right.
Like, how much tax are you going to pay? And in their case, the number was like $6.7 million, right? I mean, can you imagine? Like, you add up all the taxes over 30 years, $6.7 million. It was just some god-awful number.
Right.
Right? And we said, okay, well, what's causing a lot of these taxes? In their case, it's these stupid, I shouldn't say stupid, but these darn 401ks when it's never been taxed. And it was interesting because I remember he was saying to me, he was like, Mike, I know we need to do conversions. Like, when I showed him those numbers, he's like, yeah, I know we got problems. That's why I was interested in doing conversions. Like, what schedule should we do these conversions on to get the least, to make this number as low as possible? Like, I know I got to pay some tax over the next 30 years. How do I make it as low as possible? Which is a great question, right? This is the kind of stuff that gets me excited. I hate taxes.
I know.
So
yeah.
If we can help someone reduce taxes, I'm excited. So in their case, we kind of did the math, and we learned the ideal scenario for them was if he converted his 401k this year, because remember, he's over 59 and a half. He can use that trick that we talked about in the last segment, which is where, instead of writing a check to the IRS, he just did the withholding trick, right? So by doing that, he did his this year. Then next year, after his wife turns 59 and a half, because you do have to wait till 59 and a half, she would do the same thing.
Yep.
So all at once. And you're like, oh my gosh, they're already in a high income tax bracket now because they're making decent money. They're getting these stock options. That's taxable, right? It's like, anyway, we do that, right? By doing that approach, they ended up, now the new projected amount that they would owe in tax, instead of $6.7 million, down to about $2 million. Saves $4.7 million over their
change.
lifetime. Huge deal. And, I just simply asked him, hey, I asked Brenda, I remember Brenda saying, she's like, hey, honey, I think we could go on an extra cruise or two by saving all that money. I'm like, you guys must have some pretty fancy cruises.
$1 million cruises. How do you sign up for those?
Can you imagine?
Yeah.
But again, it goes back to step one. What is the number one mistake people make with tax planning with their retirement accounts? You think the money is all yours. In this example, they had like 1.6 million total. I mean, if you do the math, you're like, they go online, they see their 401ks. They were showing me, they printed off their statements, and the statements had their name on it, and it had a total of 1.6.
Yeah, they're like, Mike, look, I got $1.6 million. Yeah.
That's exactly what the statement said. But the best part I loved about this couple was, Dave, he goes, Mike, I know that's a BS number. Mm-hmm. He goes, because he said, based on, and this is kind of the way he said it. Mm-hmm. He said, the way I think about things, something is worth what I can sell it for and put in my pocket.
Right.
Which I think I've said on the show. So maybe he got it from me. I don't know.
Probably did.
And I probably got it from someone else. And,
sure.
That's how it goes. But he goes, I can't sell these things and put 1.6 in my pocket. If I sell this, I got to give the IRS their share. So, and that's when he goes, I heard you say that on the radio, where it's like, when like these accounts are really like a joint account with me and the IRS. He goes, that's right. He goes, so step one, you got to recognize that. Got to recognize that. Once you recognize that, you can start making smart choices. And in his case, he says, look, I like the idea. I want to buy my partner out. I want to separate from my partner. I want to take my share, give my partner their share, and just go our separate ways. And by doing that, they saved, projected, assuming a 30-year retirement and assuming tax rates don't change, they save about $4 million plus. Now, if tax rates go up in the future, they save even more. But, I mean, what a great move.
Right.
All at once made sense for them. But here's the deal. Does that make sense for you? I don't know. That's why we have these conversations. You need to be like Dave and Brenda in our little story here. Just make it easy on yourself. Give us a call, 512-886-5850. Let us put together for you a personalized prosperity planning blueprint. And one of the key features of that blueprint is it helps you, just like Dave and Brenda, say, hey, here are the taxes you're projected to pay, and here's what you could save if you make some smart planning moves, Roth conversion just being one of them. So again, Zach, what's that number again? It's like 886. Give us that number again. I always mess it up.
Mike, to get your own personalized prosperity planning blueprint, you just got to give us a call at 512-886-5850. Again, 512-886-5850. Now, like we've said, it's after hours. You'll get our answering service. You'll set up a quick 15-minute call with our team, and we'll walk you through the super simple process to get your personalized prosperity planning blueprint.
That's right. You got to make it easy.
Yep.
All right. Now, we don't want you going anywhere. Coming up, I've got yet another story where upfront conversions made sense. Who knows? Maybe it'll be like you. We'll be right back. You can look at me talking right now. I'm dressed in black today because I am confident, I am convinced that wearing black makes me look skinnier. Always a challenge.
I've got a nice slim striped shirt on.
There you go. Or yeah, but you're not like you're different from me. Your body is shaped differently. Let's just say it that way. If you are on Apple, like on iTunes or any of those podcast things, you can subscribe to our channel. Although I will say, we're talking about taxes this week. What was that? We did get a little bit of hate mail on our Apple podcast. Somebody did a review, and they said that I don't think we should listen to you because you should, instead of telling people how to save taxes, you should tell people, how to pay them or something.
Something along the lines of that. We shouldn't talk about taxes anymore, which was
we should avoid
ridiculous.
Teaching people how to reduce their taxes.
Yes.
Yeah, I think that's probably not a path I'm going to go down.
No.
If you're the kind of person that you're saying, hey, I think it's important that everyone pays more tax to the government, you're not going to like my show. I mean, you're not going to like this show. You should probably just turn the dial to something else, because I don't like me, the people we serve, they're happy to pay their fair share. They don't want to pay extra. And if we can create some creative legal strategies to help you save taxes as part of your overall financial planning, right now, that's what we're going to do. Now, heads up, we are financial planners. We help people manage their money. Like, we can help you manage your money. We help you create income plans to replace your paycheck. We help you with your insurance planning. We help you with your estate planning. Tonight, we're just talking about taxes, right?
Yep.
Mostly because they drive me crazy.
Always. Every week.
Mike hates taxes. All right. So here's another example of someone where doing Roth conversion all at once actually made some pretty good sense.
Sure.
So here we had a gentleman come in, and this guy, he does all the, let's call him, I got to come up with a guy's name.
How about Jim?
Okay, we'll go with Jim. Jim is good. Jim comes in by himself because, his wife, Frances, doesn't deal with this
Not
stuff.
involved, doesn't do the planning.
He does all the money management. And here's the thing. They're both retired teachers. Between pensions, they actually got some Social Security, but they're good. They're set. They aren't spending the money that they've got coming in, right? Mm-hmm. So every month it's like their bank account just gets bigger. So he's sitting on an IRA. Actually, it was a 403B that he had moved to an IRA. Mm-hmm. And he's got about $700,000 in it, right? And I asked him, I'm like, Jim, what's it for? What's the money for? Here was what he said. He said, Mike, here's reality. Both of our pensions are 100% to spouse. So whichever one of us die, we aren't spending the money now. One of us dies, the surviving spouse still has more money than they're ever going to spend. He goes, quite frankly, and we have long-term care insurance. We got that covered. It's like, honestly, it's just money that's going to the kids. Mm-hmm. It's really for the kids.
Right.
And so I said, okay, it's for the kids. Well, it's an IRA. So what's going to happen when you turn 72, under current law? And his response, he goes, well, that's why I'm here. Like, I'm currently 71. And next year, I'm going to have to start pulling money out. And I said, how do we feel about that? He goes, honestly, it's driving me crazy. I don't want to pull it out. It's for my kids. And he goes, here's my problem. They're in higher tax brackets than we're in, right? They're all doing great. Like, one of them's a doctor. I've got one that's a lawyer. I got a third. Like, one of his kids actually runs one of these PNC, like property and casualty, like not a State Farm insurance agency, but, an independent one.
Sure.
And he goes, that kid's making like 7 figures a year. So, which makes me think maybe I'm in the wrong business. But anyway, my point is, here he's got this chunk of money. It's for the benefit of his 3 children. They're all doing well. They're in higher tax brackets than he is. And he's got to start taking money out next year and starting to pay tax. And it's just like, we've got issues here. And so we start doing the math. Like, we do these prosperity blueprints. We start doing the math. Well, how much tax are you likely to pay over your lifetime? Mm-hmm. And then how much is left in that account that goes to kids as taxable? And here's what would have been the ideal answer. The ideal answer would have been to start taking money out of the IRA, maybe over a 5-year period, and then buying life insurance. Like, life insurance would cover both their lives. That would have been the ideal scenario. The problem, neither one of them was insurable. Mm-hmm. They both had issues with cancer in the not too distant past. Now they're over it, right? They're fine now. They're probably going to live a normal life expectancy, but because it had happened so recently, the insurance companies just wouldn't like them, right? So that was off the table. Life insurance, not a solution. So the question is, should he do Roth conversions? Should he do Roth conversions? Because if he does, if that $700,000 were all over a period of time moved to Roth IRA, then he wouldn't have to worry about required distributions. And surviving spouse would have access to the money tax-free if they needed it. They probably wouldn't, but just in case.
Right.
And it goes to their children tax-free, who are in higher tax brackets than they're in.
Yep.
So we did the math, crunched the numbers. We ran a prosperity planning report for him that we talk about all the time. It's a prosperity planning blueprint. Ran the blueprint, did the math. Here we go again. In his case, now again, you might be different. This is not advice. This is just information. In his case, actually made sense to do it all at once. Like just convert the whole thing now. And because we did the math, we're like, man, if we stretch this out over time, just the way the income worked, yeah, they would pay a lower rate, but it'd be on a bigger pot of money. When all is said and done, the cheapest way to do this, just do it now.
Yep.
Again, he was over 59 and a half. He didn't have to write a check. He could do withholding. That's what he did. He said, all right, of the 700,000, roughly 200 of it, 500 belongs to me, 200 to the IRS, roughly. He goes, that's what I'll do. I'll just do a conversion. I'll take my chunk and go my way. We'll let the IRS have their chunk. They can go their way, and we're free of the IRS for that money.
Yep.
Made wonderful sense in his situation. And that might, who knows for you, maybe you're sitting there and you're like, hey, I've got this IRA money. It's just extra money. When you're sitting on an IRA that's likely going to be money that's just extra money, this is where upfront Roth conversions sometimes make sense. Life insurance makes more sense if you're insurable, but this is where upfront, just one-time big Roth conversions, it can make sense. Mm-hmm. But guess what? Here's what I know. Every family is different. You have your unique circumstances. Mm-hmm. You have your unique situation. You're not the same as your neighbor. You're not the same as your brother or sister. Everybody's a little bit different. And guess what? Taxes are a little different for everyone too. Mm-hmm. And taxes are not what we would call simple.
No.
Our system's a bit complex, especially when you start trying to map out not just what do your taxes look like today, but what do they look like down the road. So if you're sitting there, you've got a pretty good size IRA or 401k, especially if it's over $500,000. And you're sitting there saying, man, Mike, yes, I know I need to do Roth conversions. I just don't know what the right schedule is. Mm-hmm. Well, let's just make it easy on you. Why are we making this hard? Make it easy. Just give us a call, 512-886-5850. Did I get that right?
You got it.
That's amazing. I just pulled that one off the top of my head.
Nailed it.
Do a radio show for 2 years. You might remember the phone number at some point.
About time. No.
So there it is, 512-886-5850. Just give us a call. It's after hours. You talk to our answering service. Here's what they're going to do. They're going to set up a 15-minute phone call. It'll be you and one of the advisors. And their job, let's learn a little bit about you. Let's put together for free a personalized prosperity planning blueprint. And part of that blueprint, it helps you make good choices with your investing, with your income planning, how to make your paycheck, how to replace that paycheck so work can be optional. But part of it is also taxes. And our goal is to help you make those great choices with your Roth conversions, right? So Zach, wrap this up. What's our number one last time?
Yep, Mike. End of the show. To get your free prosperity planning blueprint, all you have to do is give us a call, 512-886-5850. Again, one last time, 512-886-5850.
All right, gang, that's our show. We will see you again or talk to you again next week.